Technical analysis made easy, a starting place for new traders. Chart types. The most basic tool for any technical analyst is a chart. One of the most common types of charts is a line chart, which plots price points over a fixed time interval, connecting the points with a line. While this type of chart can be used in plotting the traded price of a futures contract, like the E-mini S&P, it is also very common to see other types of data on a line chart, such as economic or statistical data. Line charts are also standard for comparing price data for multiple assets in the same chart. The line chart can help determine direction from interval to interval. Is the market increasing or decreasing as time passes? Bar charts are an improvement upon line charts when trying to understand price action in the financial markets. The bar refers to the data contained in each interval's price action. The bar comprises 4 data points: the open, high, low, and close of that interval. The open is the first recorded price during the time interval selected. For instance, on a daily chart, the open is the first trade or print of the day. This is indicated by a horizontal hash mark to the left of the vertical bar. The high and the low prices designate the top and bottom of the vertical bar. This is also known as the range of the bar. The close is marked with a hash mark to the right of the vertical bar. For a trader or investor, this is an improvement on the line chart, as it helps to determine the direction of trading within the time interval. These bars are also called OHLC bars: open, high, low, close. Candlestick charts are a popular variation of the bar chart. Like bar charts, candlestick charts use open, high, low, and close data to create the candle. The main difference is that the body of the candlestick is formed by extending the hash marks at the open and close prices and forming a rectangle with those hash marks as the top and bottom. The body is colored according to the relationship of the open and close. If the close is above the open, the body is green, typically considered a positive or bullish color. When the close is below the open, the candle is bearish and colored red. Another common way to color candlesticks is white for bullish candles and black for bearish candles. The distance from the top of the body to the high is called an upper wick, and from the bottom of the body to the low is the lower wick. One benefit of candlestick charts over bar charts is that the color of the candle makes it easier to determine direction or price action for the interval. There are 3 inputs that are necessary for creating a chart: symbol, time interval, and chart type. The symbol, or ticker, is the code used to identify a particular financial instrument. For example, ES pulls up the E-mini S&P 500 future, and CL represents WTI crude futures. The time interval designates the frequency at which a new point or bar/candle is created on the chart. A daily chart creates a new interval with a new trading day, whereas a 10-minute chart creates a new interval every 10 minutes. It is assumed that the data contained in the interval represents all trading data for the interval. The chart type serves as the template for how the data is displayed. A bar or candlestick chart is the most common type of chart for traders. How are these chart types used? Line charts are good for determining trends, whether viewing one or multiple markets. The bar and candlestick charts provide the trader with a deeper level of understanding of market behavior. Viewing the trading range along with open and close prices can help determine if an observed trend is continuing or if it may reverse. Bar/candlestick charts are useful in identifying patterns, which are created by the price action on charts and indicate market participants' reaction to market forces. Patterns can give guidance as to whether a trend might continue or reverse, possible target areas for price, or a combination of price behavior and expectations. The study of candlestick patterns contain many unique names and candle combinations, but the purpose is the same as patterns found on bar charts: to identify how price action might progress based on buyer or seller behavior. The patterns can be as short as one bar or can be multiple bars. Generally, the patterns are designated either bullish or bearish and are complementary, although the names might be different. We will discuss candlestick patterns in another session. In conclusion, historical price charts are the main environment for technical analysis, and understanding what the price bars represent and how they are applied in technical analysis will help give you better insights into future price moves. In our next video, we'll discuss indicators that identify trends in the market and how they can help identify entry points. Thank you for watching.